Hi all, good evening and welcome. I am Mangesh Deshmukh and on behalf of CareEdge, I welcome you to our today's discussion on hospitality horizons, rising from recession to revival and beyond. And sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Giridhar Sanjeevi, Executive Vice President and Chief Financial Officer, the Indian Hotels Company Limited. Mr. Kallol Kundu, Executive Vice President and Group CFO, the Oberoi Group. Mr. Nikhil Sharma, Market Managing Director, Eurasia Region, Wyndham Hotels and Resorts. This session will be moderated by Sachin Gupta, Chief Rating Officer at CareEdge. We will commence this session with the presentation by Ravleen Sethi, Associate Director at CareEdge. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries during our panel discussion session. Now, may I invite Ravleen to make a presentation.
Thank you, Mangesh. Good evening, everyone. The Indian hospitality industry has displayed remarkable resilience, rebounding from the substantial downturn experienced during the COVID-affected years. While fiscal year 21 was characterized by survival, fiscal 22 was marked as a year of revival, and fiscal 23 stands as a year of notable growth for the sector. Encouragingly, the demand outlook for the Indian hospitality industry in fiscal 24 remains positive on account of various factors. As the sector has entered its growth phase, we at CareEdge thought that this will be an opportune time to give our view on the sector and get comprehensive insights from the experts on various aspects, along with sustenance in high room rates and strong occupancy levels in the light of the forthcoming capacity. We are covering the entire presentation in three parts, wherein we'll first take you all through the travel and tourism sector, as it is inextricably linked to the hospitality sector. We will then move to the key trends in Indian hospitality sector, and thereafter we shall have a look at the credit profile of hotel players and CareEdge ratings outlook and way forward. To set the context for the flow of presentation, the key messages are that the demand tailwinds are strong, supported by various factors. Amid the strong demand and the narrowing gap between supply and demand, all the key performance indicators for the sector has improved, cushioning the RevPAR growth by 9% in FY23 over and above the pre-pandemic levels. With this, the industry revenue has surpassed the pre-COVID levels in FY23, and CareEdge is expecting a further growth of 10 to 12%. Supported by the strong demand, players are now signing new openings and the supply pipeline is building. However, the growth in supply is expected to be lower than demand, supporting the occupancy levels. The mid-scale economy share and the upper mid-scale share is expected to increase in the branded room inventory, and the credit profile of players have improved significantly in 23, reflected in the strong credit ratio for the sector. Let us now have a closer look at each of these key messages. Travel and tourism to begin with. Indian economy currently ranks ninth in the world in terms of the total absolute contribution of travel and tourism to the world GDP. Here in Exhibit 1, the dark blue bars represent the absolute contribution of the travel and tourism to India's GDP in USD billion and calendar year wise, and green line is representing the year-on-year growth, year-on-year contribution to the travel and tourism sector to the India's GDP. Operating in a highly cyclical industry and exposed to discretionary spends, travel and tourism sector witnesses significant variation in its total contribution through an economic cycle. Contribution has been range bound in the pre-COVID era to about 180 to 200 billion USD. In 2019, the contribution stood at 213 billion USD, approximately 7.5% of the nation's GDP. However, in 2020, a considerable decline was witnessed, which is attributable to stringent lockdown imposed during COVID, which profoundly impacted the sector. After a devastating 43% fall, the travel and tourism recovered by 46% in 21, boosted by vaccination drives and strong pent-up demand in the year of 2022, the same registered further growth and stood at almost 90% of the pre-pandemic spent levels. Noteworthy is that of this contribution, almost 90 to 95% can be attributed to domestic demand alone. Factors like new tourism policy, target to create additional airports and large infrastructure development through roads and highways will give boost to the sector. In the light of the impetus on the sector, CareEdge anticipates that the Indian travel and tourism industry shall grow by 9 to 10% annually on an average from 2019 pre-COVID levels to 2032, reaching a total value of USD 470 to 500 billion and contributing significantly to the total GDP. To understand the key trends in the travel and tourism sector globally and India, let us have a closer look at the international tourist arrivals around the world. The green bars in Exhibit 2 and 3 represent the world international tourist arrivals in millions in each of the calendar year and world tourism receipts in USD billions, respectively. And blue line in both the exhibits represent the India share in the world total. The number in the green circle represents the India's ranking in the world. International tourist arrivals in the world, which stood around 1460 million in 2019, plunged to 407 million when COVID had struck, and they remain in the similar range in 21 due to continuous travel restrictions. With the relaxation of restrictions and increase in demand for travel, the global tourism improved. Traffic more than doubled in 2022 and stood at 65% of the pre-pandemic levels. International traffic is expected to reach 90% of the pre-pandemic level by the end of calendar year 2023. An interesting fact and trend which has emerged here is that India ranks 17th in terms of the international tourist arrival in the world as of 2021. And in pre-COVID era, this was 25th rank, which also is significantly up from the rank of 50 it was in 2003. A similar trend can be seen in Exhibit 3, where international tourism receipts recovered to USD 1,000 billion mark in 2022, growing almost 60% compared to 2021 and reached 70% of the pre-pandemic spent levels. India here ranking has improved and currently stands at 14th. Factors such as government push to tourism, the enhanced medical tourism, and comparatively weaker currency for international tourists have enabled the country to make its position in the world tourism. With India's share of this sector increasing as projected, India's rank in the world total shall further improve. Having looked at the global trends in India's share, let us look at the air traffic in India. Here in Exhibit 4, the total annual air passenger traffic has been depicted calendar year-wise. The air traffic in 2019 stood at 350 million. Due to COVID disruptions, the air passenger traffic in 20 witnessed a steep decline and stood at almost 40% of the 2019 levels. And since the restrictions continued in 21, there was not much recovery. India resumed all regular international flights in March 22, and total air passenger traffic in 22 registered a significant growth over 21 and recovered to 85% of the pre-pandemic level. It is expected that it will surpass this level in 2023. If you also see at the actual data of 6 months in the current fiscal from Jan to June, air traffic had already recovered 7% over the 2019 levels. We would like to draw your attention to the slide right where the breakup of the total air passenger traffic in the first 6 months is given between international and domestic. And clearly the domestic tourist was the first to bounce back, and it is 11% over and above 2019 levels. International tourism has also bounced back, and in the first 6 months of 2023, it is now only 8% lower than 2019 levels. Similar trends of recovery can be seen in foreign tourist arrival as well, which are presented in Exhibit 5. Focus on increased regional for the hotel sector. After having understood the travel trends, we now move to the trends in hospitality sector. In Exhibit 6, the dark blue bars are average room rates, the grey bars are the revenue per available room, and green line is the occupancy levels. We have tried to segregate this period into different phases since fiscal of 2003. The Indian hospitality industry witnessed a boom period during fiscal 2003 to 2008, marked by rising occupancy levels and average room rates, with RevPARs growing in each of the years. Thereafter, the sector got impacted by recession phase of 2008, which was then impacted by a double whammy of a fall in demand and strong supply addition. While the sector witnessed some revival after fiscal 14, with moderate demand growth until fiscal 20, it was significantly impacted during the pandemic. The period was the worst period in the history of the hospitality sector, with the RevPARs declining by almost 70% from FY20 levels. After an abysmal FY21, the sector made a steady recovery in FY22 as successful vaccination drives and reduction in COVID cases helped improve the travel sentiments. FY22 has witnessed a sharp rebound in the RevPARs, and 23 registered a further growth and stood at 9% over the pre-pandemic levels. Recovery post-COVID has pushed the sector now in its growth phase. In FY24 as well, with confluence of positives, which we will talk about next, occupancy and average room rates are expected to register growth over FY23 levels, hence supporting the credit profile of the players. CareEdge estimates a RevPAR growth of 6 to 7% in FY24 over the 23 levels. Let us now have a closer look at the trends in the demand drivers from pre to post-COVID era. In Exhibit 7, we have segregated the demand drivers in each of the years. Green signifies a favorable demand, yellow refers to a neutral one, and red signifies unfavorable. In fiscal 20, we just talked that the sector was an upcycle and all factors were favorable. In fiscal 21, which was marked by strict quarantine and restrictions, demand witnessed stark deterioration. In 22, the leisure made the quick return and was single major factor at least till the first half of the fiscal. H2 witnessed some uptick with marriages and business travel returning with opening of offices, while foreign tourist arrivals and MICE were far from recovery. In financial year 23, all drivers bounced back, while leisure continued to be the strongest of all, but business and MICE also recovered to a great extent. And foreign tourist arrivals, though rebounded, but were still lower than the pre-COVID levels. In the current fiscal, demand has been rebounded from all segments and is getting a stronger cushion from rebound in foreign tourist arrivals as well. Further G20 meetings is expected to help inbound tourism, and events like Cricket World Cup and a lot of initiative by government are all expected to contribute towards healthy demand in the sector. Moving on, while we have already spoken on sector-wise key performance indicators, here we have stated few key market performance indicators. We are not going in detail here, but just a reiteration that few cities recovered first and faster, like leisure places, Goa and Udaipur, metros like Mumbai and Delhi, and few places witnessed a gradual recovery, like Pune and Bangalore. But almost all cities and states now stand recovered, with few of them having registered pronounced growth over the pre-pandemic levels. The strong uptick in demand is expected to drive the rise in room capacity additions. We are now looking at the supply dynamics in Exhibit 9, where the blue bars present the branded room inventory of hotels over the years, and grey line is the growth in supply. Period from 13 to 16-17, the supply increased significantly in the branded room space, and with lower occupancies, it added to the V's of the sector, resulting into down cycle. Thereafter, there was a steady recovery, but in fiscal 21, supply was at a multi-year low as the hospitality industry practically came to a halt with the outbreak of the COVID. Poor financial position of the players and uncertainty over the resumption in travel led to delays in project completion, which were under implementation. And these were all resumed by players in fiscal 22, leading to a reasonable supply growth in 22 and 23. India has about 150,000 branded hotel room inventory by the end of fiscal 22, and the industry is expected to add another 40,000 rooms by fiscal 27, with the supply registering a CAGR of 3.5 to 5%. Exhibit 10 below shows the percentage share of each segment in the branded room inventory in fiscal 15, fiscal 22, and how will the mix fare in fiscal 27 when the planned supply, which we just talked about, will be added. Presently, the supply is more balanced across different segments as compared to an earlier mix that was heavily weighed towards luxury and upper upscale hotels. The supply concentration in the luxury and the upper upscale segment is expected to reduce further, as can be seen in the green bars, which represent fiscal of 2027. This is majorly due to higher share, roughly about 66% of the new supply coming in these sections. The industry dynamics has witnessed a significant shift from investing to exploring the multiple asset-light options, which helps increase the revenue and margins without major capacity additions. Having talked about the total supply at pan-India level, we will quickly walk you through the supply in the key markets in Exhibit 11. New Delhi and Bangalore have the highest number of room inventory, followed by Mumbai. Bangalore and Mumbai are seeing good traction in the upcoming supply. In the absolute terms, Goa has seen the maximum growth in the recent years. Gurugram and Navi Mumbai have seen a moderate increase in their supply, but these markets are upcoming commercial hubs and are likely to witness increased supply. And about 15 to 20% of the total supply is coming at key leisure destinations. With creation of a robust demand base, the upcoming supply currently shows a clear correlation vis-a-vis the upcoming tourism and infrastructure developments. We are now moving to the section of the presentation wherein we will see how these operational parameters, demand and supply trends, benefited or weighed on the financial profile of the players. Hotel revenues are highly cyclical in view of the demand-driven, price-elastic business model, as well as the lumpy supply-side dynamics. In Exhibit 12, the green bars present revenue in rupees crore for a sample set of listed players, and blue line is a year-on-year growth in revenue. From the period 16 to 20, revenue for these sample set of players were in the range of 9,000 to 10,000 crores. Fiscal 21 witnessed sharp decline in revenue profile of players, when apart from the room revenue, players also lost significantly on the food and beverage, which typically contributes 35 to 40% of the top line. Performance of the players improved significantly in fiscal 22 with a V-shaped recovery, and revenues got reinstated at the pre-COVID levels. With strong recovery in occupancy and the surge in the room rates, the sector experienced a reversal of its fortunes in fiscal of 23, with 68% year-on-year growth in revenue profile for these sample set of players. Given the strong demand tailwinds, CareEdge estimates further surge in the revenue profile of the industry in the range of 10 to 12% in the fiscal of 24. In Exhibit 13, the blue bars represent the operating margin trends, which are for the period 16 to 20, range bound in 19 to 20% for the sample set. The sharp decline in revenue profiles due to COVID, coupled with the escalating cost structure, precipitated significant operating losses for the sector during fiscal 21. During 21 and 22, the industry players embarked upon a comprehensive cost containment measure. As revenues improved, the industry posted profits at operating levels in fiscal of 22, though lower than the pre-COVID levels. FY23, which marked the growth phase for the sector, not just the revenue grew to a decadal high for the sector, but also the profitability registered a significant increase, leading to impressive operating margins of 27%, which is a substantial leap of 700 bips compared to a pre-COVID level. This positive momentum is anticipated to persist as the sector propels forward. Any sharp decline in the key performance indicators owing to macro environments or exogenous factors or significant surge in cost remains a downside risk to our assumption. With improved revenue and profitability profiles, the leverage and the coverage indicators have improved, as is visible in Exhibit 14, where blue line is representing interest coverage and green line is representing the debt to EBITDA for the industry sample. The debt to EBITDA in the pre-COVID era averaged about 4 to 5x, and with rising debt and falling profitability, the leverage deteriorated in fiscal of 21 and 22. With a significant increase in profitability in fiscal 23, players were able to pare the debt levels, and debt to EBITDA indicator improved to 3x, which is improvement over the pre-pandemic levels. Similar is the case with the interest coverage indicators, which used to hover around 1.6 to 2x in pre-COVID years, witnessed a dip in 21 and 22 and improved in fiscal of 2023. With sustenance in operating profitability, these parameters are expected to sustain. In Exhibit 15, the return on capital employed for the similar sample set of players is depicted. Hotel sector being a long gestation and capital intensive sector, historically the ROCEs have been in the range of 4 to 5% for the industry average. The same has significantly improved in 23. Also, the players are now pivoting towards management contracts, basically an asset-light strategy, which shall result in better leverage and coverage indicators, and also returns shall improve. With improved financial metrics, the credit ratio for the sector, which is calculated as an upgrade to downgrade ratio, also witnessed stark improvement and stood at 4 as depicted in Exhibit 16. FY21 and 22 were the years where significant amount of downgrades happened owing to the worsening operating metrics and stretched liquidity for the players, which is visible in the low credit ratio. Exhibit 17 represents rating dispersion for care-rated players in the sector. 44% of the rated entities, which have about 18% of the debt that CareEdge rates, is in the below investment grade. These are largely the small players. And 56% of the rated entities, with 82% of the rated debt, is in investment grade. Having talked about the industry dynamics and the credit profile of players, let us look at the emerging trends and driving factors in the sector. Here we'll also briefly touch upon the key monitorables. Among the drivers of the emerging trends, healthy demand is expected, and a clear focus on infra by the government, including the airports and roads, will attract a lot of tourists and shall boost the tourism and the hospitality sector. Asset-light model is gaining traction, and rebranding is happening, which is adding to the organized supply in the sector. Amongst the monitorable, sector currently is in a sweet spot, but inflationary pressures may hurt margins. Also, for the margins to sustain at projected levels, the continuation of the cost containment measures by the hoteliers, even after the demand revival, is the key. Moderate supply in fiscal 24 are to keep the occupancy buoyant, but the sustenance of the high room rates when new supply starts kicking in will be a monitorable. And also, the operating performance of the sector remains vulnerable to cyclicality and seasonality in the industry and also the exogenous factors. Hence, all of these continue to be the monitorable for the sector. With this, we come to the end of our presentation. Thank you, everyone. And I now hand over to Mangesh to take this session forward. Over to you, Mangesh.
Thank you, Ravleen. Attendees are requested to key in their questions, which we will take up during our panel discussion. Now, may I invite Sachin Gupta to take over the session, please. Sachin is the Chief Rating Officer and Executive Director at CareEdge Ratings and has over 22 years of experience in leadership positions across the credit rating business. Prior to joining CareEdge Ratings, he worked as a Senior Director at CRISIL and managed the corporate and infrastructure ratings. Over to you, sir.
Hi, thanks, Mangesh, and a very good afternoon to all our panelists and the audience. May I request all the panelists to switch on their video? Thank you. So I'll start with a quick round of introduction. So first we have with us Mr. Giridhar Sanjeevi. He is Executive Vice President and Chief Financial Officer at Indian Hotels. Mr. Sanjeevi is a chartered accountant, rank holder, and an MBA from IIM Ahmedabad. He joined Indian Hotels Company from Merck and Company, where also he was the CFO for South Asia. He started his career in ITC, and then he was with ILFS as an investment banker. Then he spent several years with Diageo as their global business director, and he was covering M&A and strategy there. He's also built experience in retail businesses through stints in Shoppers Stop and Aditya Birla Group. He's won several awards, including Most Influential CFOs of India Award for SEMA in 2015 and 2016. A very warm welcome, Mr. Girdhar.
Thank you. Thank you. That was very generous.
Yeah. We have with us next is Mr. Kallol Kundu. He is the Executive Vice President and the Group CFO at the Oberoi Group, and he also serves as Director on the board of 6 companies. He plays a pivotal role in the expansion strategy of the group, and he's established strategic partnerships both within India and internationally for the group. He also led an impressive 25% reduction in fixed cost at his group in response to the challenges posed by the COVID-19. He also has profound expertise extending across a spectrum of industries ranging from FMCG, power, hospitality, EPC, and real estate. He also has quite an illustrious academic record, having got his certification from FCA, then he's LLB, he's MBA Finance. He also has CISA, CFE, and DISA. A lot of illustrious qualifications. He stands recognized as a top 10 CFO and has won several accolades and awards for his transformative impact on businesses. A very warm welcome, Mr. Kundu.
Thank you. Thank you so much.
And then we have with us Mr. Nikhil Sharma, Market Managing Director of the Eurasia region with Wyndham Hotels and Resorts. He is also an author of a book, Rumi and Kabir Consulting. Nikhil is currently a board member at FHRAI, which is the Federation of Hotel and Restaurant Association of India, and HRANI, which is Hotel and Restaurant Association of Northern India. He brings over 2 decades of experience in the hospitality industry, and before Wyndham, he was the Chief Operating Officer at Ginger Hotels. He was also one of the founding members at the Lemon Tree Hotel Company. Nikhil holds a diploma in hotel management from the Institute of Hotel Management, New Delhi, and also has a certification from Cornell University's School of Hotel Administration. A very warm welcome, Nikhil.
Thank you, Sachin. Just on the introduction, something that I want to mention for Giri is that he can quote from Ramayana and Mahabharata at any given point of time. So I think that definitely needs to be mentioned in his introduction.
Okay, I am missing the joke here, but okay, great. Oh, is this about the book?
No. I mean, I haven't met anyone who can quote from Mahabharata and Ramayana like Giri.
I see. Okay. So Girdhar is the expert here on that. Okay.
Absolutely.
Okay, Great. Thanks, all of you for joining in. It's very privileged to have such an illustrious panel. I think we have the entire hospitality industry. The biggies are here. So once again, thanks. I'll start with Giri yourself. And this is a question which I think everyone is asking. It's kind of clearly given that the sector is in a very sweet spot. And even in the immediate future, we are looking at events like further bookings on G20, the returning of MICE, the World Cup, the foreign tourist arrivals. So all of that seems to be quite positive. But you've also seen the industry, gone through tough times and all that. So how, if you were to look a little beyond the immediate and say, FY24 is fine, you will have high visibility. But say if you were to go up till FY25, how are you seeing the demand to play out and more in the, say the luxury and the, as we call it, the upscale segment?
No, thank you, Sachin. I think we are quite bullish on the long term. I think the way we like to talk about it is a simple funnel approach where we talk about first the India story, secondly, the hospitality story, and third, of course, the respective company strategies, actually. That's the way we look at it. I think the India story is very positive. I think all of us agree that in the next foreseeable future, India will probably grow at increase incomes of the $1 trillion, becoming the third biggest economy in the next few years. I think, and therefore all of that translates into incremental per capita GDP, which means increasing disposable income and therefore increasing ability to do discretionary spending. So I think consumption. So therefore I think I'm very bullish on the Indian economy. Following which, I think what is critical for us is the whole consumption theme, actually. I think the consumption theme is really, I feel that we are in for a few years of strong consumption themes actually for the country. And I think, why do I say that? First of all, let's look at the demographics itself. From a demographics perspective, what's happening, Sachin, is that while people talk of the demographic dividend in terms of the younger people coming up in the productivity and therefore the ability to spend, I think what is happening is that it's not just the younger people. It is also the baby boomer equivalents of 55 plus who today are empty nesters. And this is the first generation which neither depended on their parents nor on the children. So they're also spending. I feel that India has not caught on to the power of the spending power of this baby boomer generation, actually. So taken together, I think we have the next few years in terms of spending patterns. The third thing I would say is how the growth is happening. If I look at the economic growth is not just concentrated in the key metros, but because it's actually getting more democratic around the country, thanks to the infrastructure development, the rise of different cities and all of that. If you look at what's happening in the interiors of the country in terms of conversion of assets from gold into financial assets, in terms of movement to mutual funds. So today, for instance, what I'm disappointed usually is that people compare the hospitality trends by looking at the airline passenger traffic. But if you start looking at, say, where is the mutual funds getting money from actually? Are they getting it from the key metros or the interiors? And you will see a lot of money is coming from the interiors, actually. That's where the growth is happening. So as the formalization of the economy, the ability, the conversion of gold to financial assets and the increasing prosperity in the interiors. So what's happening is that the ability to spend goes up. So that's another pattern where you're basically saying that growth is not only coming from the key metros, but interiors, actually. So hence, I think overall, the next few years promises to be good for the country. And therefore, there's a very good rub-off on the hospitality sector also, because ultimately, this is a discretionary spending industry. So that's one part of it. Secondly comes the industry supply demand that we talk about, actually. Very clearly, as was pointed out by Ravleen in her presentation, supply has been impacted. And if you look at one of the charts, the total branded rooms in the country are some 150,000, slated to go to some 180,000 or so in the next 3-4 years, which is nothing. It is smaller than the city of New York, as an example, actually. And where is all the growth coming? They're not coming in South Bombay. They are coming in the interiors. In fact, this is also reflective of the economic growth, actually. And therefore, I think the supply demand is also in a situation where I think the supply is not significant. And coming to demand, I think for all the factors that Ravleen spoke about, in terms of, the incoming foreign tourist arrivals, the overall economic development, the consumption theme, the demand is likely to outpace the supply actually. So if you take the combination of the broader economic growth and the implications on consumption and the demographics, and then you look at the supply demand situation, I think it's good. I think while people worry about what happens next year, this year of G20, this year of World Cup, etc., I don't think you should be worried about it at all, because in a country of this size, there's always something which keeps happening. And I think the industry is, of course, going to benefit. So I'm quite bullish that this cycle is likely to be longer than what we have seen in the past. Of course, how companies take advantage of the cycle is left to their relevant strategies, actually. But I think overall, we are quite positive, is what I would say, actually.
Got it, Giri. It was quite a comprehensive, update on how you're seeing the overall industry. And I think the big point that I kind of took from this is that you are actually banking on a long-term growth upcycle for multiple reasons, as you mentioned, whether it's the India growth story or the consumption, the baby boomers, the increased spending, people may be more comfortable spending 20,000 rupees on a hotel room than maybe, the earlier generation and people of the past have been. So,
in fact, I'll just add one more comment actually, and this is what my boss says in some of the meetings. It's a very relevant comment actually. We are 1.4 billion people actually. Let's say the relevant number of people are about 300 million as an example. Even if 1 million of them travel 3 additional nights in a year, actually, it's 3 million room nights. You don't have that kind of room nights. And with things like the Reliance Jio Convention Center, the Pragati Maidan and others coming up, I think if you see, if for instance you need 500 additional room nights because of a conference in Bombay, you just I think these are real issues, real things, is what I would say actually.
Got it. Thanks a lot. Let me bring in Mr. Kallol Kundu in. Similar signs, how are you reading the demand thing? And so one bit I would like to just add while, Giri has given quite a detailed response. But, one question that people always feel is, and especially because of the cyclicality that the industry has seen in the past, is that are we really, seeing a huge pent up demand, especially on the leisure side? Because maybe people wanted to spend money in Goa and Udaipur and all that. And maybe they were taking those luxurious holidays because they did not get visa for overseas travel and all that. Because as we saw, a large part of the demand was kind of coming through from the domestic travelers. So is this kind of the pent up demand, which is kind of making it, such a great set of numbers that we've seen across the players? How do you see it?
Thanks, Sachin. Well, first and foremost, I think, this concept of pent-up demand, I really don't know if industry insiders use this term. We definitely don't. And I'm sure Giri and Nikhil will agree to what I'm saying. This pent-up demand terminology has come mostly from analysts and investors and people who are number crunchers. But so far as we are concerned, I would completely agree to what Giri mentioned. Maybe add a couple of points there. He did mention about baby boomers. Let me bring in another category, which is called Henrys.
Sorry?
Which is called Henrys, which is high earners, but not rich yet. So,
Okay.
So there's a large population of Henrys who are really coming up in the Indian economy. And they're large spenders. Unlike people of, the last 3-4 generations earlier, where we were very hesitant to spend because we had a lot of, responsibilities to fulfill for ourselves and for other generations. I think all of these new categories of spenders, they are far more liberal in their spending patterns and all. So that's one point that I would add to the already comprehensive coverage that Giri did, from mutual funds to interiors to, to all of. But a couple of points more I would add. I think when you evaluate the way demand works, you've got to look at not only one industry or two, and especially despite contributing 11% to the GDP or 10 to 11% of the GDP, I think there's a long way to go. But if you look at the spending patterns, why is, let's say the automobile sector, for instance, the Mercedes of the category of cars, why are they doing record profits? Why are single malt drinkers increasing and skyrocketing? I mean, I'm not talking on the social side of the story, but on the spending pattern. You look at any of these, kind of spending categories, and you'll find that this is increasing. Where are they going to spend the money? Now, one argument often keeps coming is that, and it's similar to the question that you asked, pent-up demand, that maybe people were constrained by not being able to travel out of the country. So there are quite a few arguments to that, Sachin. One is that, like Indians couldn't go out, similarly foreigners couldn't come in.
Couldn't come in, yeah.
And please compare the number of foreign tourist arrivals or foreign arrivals into India with Thailand or with any other country for that matter. So it's I think anybody can gauge what the limit could be. The second thing that I would point out is look at the quality of the hotels that that are there in India, for instance, and many of us, of course, have a presence in regions abroad. Tell me one city, let's say any gateway city in the world, where you will get a really good hotel of the caliber that Indian cities or Indian hotel, the industry provides, where you get hotel rooms at $200 to $50, right? So obviously, these are all pointers towards the fact that there is no dearth of, sort of demand that is going to come here. So on one side, we see that the propensity of spending is going up. On the other side, we see that the levels of profits or levels of revenues that are prevalent today in India has a long way to go from here on. So really speaking, and I mean, Giri has already made the point about the supply side, which I will not talk about. So there's really very little. I see only two ways in which the hospitality industry could be affected. One is if the operators or the companies or the industry players really do something stupid, or if there's a black swan event or something in the nature of COVID or something. I mean, we've seen things like the Ukraine war, for instance, has not really affected the tourism in India or the hospitality business in India. So I would very much agree to the overall sentiment that it is bullish. One other point I would add is that while we should be skeptical, we should prepare ourselves for the worst and hope for the best. But this question always kept coming back to us for the last 10 years as to why are ARRs range bound? When is the cycle going to come up? Now that the ARRs have started going up, the question is now coming from the customers and consumers as to, okay, how much more? So it's really a dichotomy, and I think it'll somewhere balance in between the two. And I think one very important point is the kind of industry that we are, especially in India. And I'm not still talking of what can be done by the companies abroad. But even in India, there is room for everybody. I think there is room for volumes, there's room for premium, there's room for luxury, there's room for everything. So frankly, I don't find a reason as yet to not be bullish.
Got it. Fantastic. Let me get in Nikhil in. And Nikhil, in your current responsibility, you are looking at Eurasia region. What I would really, because, all of us are seeing the India story, what we also would like to get a perspective from you. How is it outside of India? Because is it only in India that we are seeing such a, secular growth? And as Giri and Mr. Kundu mentioned in terms of it being a long-term growth cycle, how are you seeing the story play out outside of India?
Thanks, Sachin. Firstly, I just want to stick to the India story, and I will give you an outside-in view.
Sure.
India is clearly the hero globally in terms of positioning, in terms of growth, in terms of hospitality, and international companies wanting to put their money in. So Wyndham is in 95 countries. We have more than 9,000 hotels globally. India is a key strategic market for us, right? The only other market globally, and I'm not talking about developed markets like Germany and Denmark and so on and so forth, but if you were to look east of Europe, there are only two markets globally that actually command that attention. One is India, second is Saudi Arabia. Of course, you're seeing the CEPA region, you're seeing Vietnam come up, you are seeing Indonesia come up. But the big focus, if you ask me, is on two countries, which is India and Saudi.
Got it.
That's the long and short of it. But just two more points on the India story. And I think the Indian government is doing a lot, whether it is the Swadesh Darshan being relaunched or whether it's the 100% FDI into tourism that's happening. The government is moving in the right direction for tourism. And I think those changes that were needed are now happening slowly but surely. And that is only going to aid not only domestic tourism, but international tourism that is coming back into the country.
Got it. Thanks. Giri, you did mention about, from a demand supply situation, whatever supply that we have the visibility of as of now, the demand will still be outgrowing it. Now, does that mean, and let us assume that, that's a general sense and everyone kind of believes in it. And if you were to put the money to where the view is, are we therefore going to see a large investment on building new properties? Is that what we are kind of expecting? Very different than, say, what we have seen in the last many years. We didn't really see any aggressive growth. How are you seeing that in terms of the capacities and aggression of the developers or the hoteliers?
Yeah, no, I think clearly in the pandemic, the whole appetite from the perspective of owners as well as bankers were very limited. And people were all wondering what happens when the ECGLS runs out, and would the companies be ready and able in terms of their balance sheet. I think the recovery in the industry has shown that even if ECGLS has run out, I think companies seem to be okay. Of course, if they have debt, they're paying interest cost. I think like some of us have no debt, so we don't pay any interest cost. So I certainly see the appetite in terms of investments kind of coming back up, both from the owners as well as from the bankers, actually. India, of course, has been a country where institutional capital beyond real estate has been limited. It's largely been individuals who have perhaps inherited land from their forefathers and they've kind of built properties on top of it. And that's been the kind of pattern which has kind of played out. I think institutional capital is also slowly coming in terms, you see REITs are getting clearer. You see institutional capital coming in. The real estate people are now doing a lot of mixed use construction, which is both offices as well as hotels, actually. So I'm certainly seeing that supply is coming back, though I think the problem in India in supply is that it is not easy in terms of bringing in new supply because the time to construction, the approvals take a lot of time. Therefore, what we have been telling investors is that for the next 3 years at least, we do expect supply to be slower, but very clearly post that supply should come, actually. So hence, I think supply will come. Of course, one thing is that people need to be careful in terms of how much they spend. One concept in this industry we use is not return on capital, but return on ego, where owners sometimes build a white elephant because they want to show the world that they have built a 5-star hotel, actually. And I think many of them who did that, and I've seen several examples where the cost to construction was significantly higher than what it should have been, actually. In fact, in our own business development work with the owners, we like to be involved in the design stage so that we can help the owners in terms of an optimal investment, which kind of ensures that there is adequate return on capital employed. Because ultimately, you'll have to pay the bills in terms of interest and all the costs, actually. So we like to do that. And hopefully, I think that sense is kind of coming back, actually. Of course, there'll be mistakes. People will kind of make mistakes, actually. But overall, I certainly think that the appetite for supply is definitely coming back.
Got it. Let me get in, Mr. Kundu. And in our presentation, Ravleen also spoke about as a trend, which is the asset light model. Now, historically, it was mostly own and operate kind of a model, which the big daddies of the industry used to work with. And now, obviously, we have a lot of foreign players who run completely on a management contract model. Now, which way is the industry going to go, especially for brands which are very well recognized and all that, and the capital is scarce. So, but give us a flavor, because sometimes the promoters may feel that, why do I buy it? Let me just construct it myself, and then the ROC, at least on the spreadsheets, look good. Finally, they may or may not come. So your thoughts on that, in terms of the changing trend, and how do you see it, a little bit long term, 5 to 7 years kind of a trend? How do you see that whole thing playing out?
So Sachin, I see your question as a very intelligent one, which could get different answers from different panelists on this occasion. So that's quite an intelligent one, because so far we've been united in one way. Well, let me put it this way, that I think if you ask me, I'll give a very personal analysis of what I feel, having spent 22 years in this industry. I think it's not a straightforward answer, and it's not really the fact that the managed hotels way started long back. It's not a very recent phenomena. It may be a slightly more recent phenomenon in India, but from the 90s onwards, at least, we've seen a large number of at least players abroad going into this mode.
Correct.
Now, the way we look at it is, I think there's a need for a balance between the two. And the reason I say that is because it depends also on the company's strategy on where you want to play. So, for example, if somebody is a volume player and really is okay with managing hundreds and thousands of hotels, then a management contract may be definitely the right way to go for them, because you have a very structured model in which you operate, and the management fees that you earn go straight into your EBITDA. So it makes sense to go that way. There are others who would say that let's say we want each of our properties to be more niche and more, kind of luxurious, or we want to play in a particular segment which is more premium than not. In that case, it might make both financial sense and operational sense to go the owned way. And the reason for that is that if you really want to pay individual attention, it's like saying that you go to a classroom where students are taught in batches. So there, of course, it's okay to disseminate knowledge which is more systematic and which is done in a more sort of commoditized way. So pardon me for using the term, but it's not in a negative sense. I'm just trying to say that it's more structured, probably. And there are those others, probably coaches or tutors who would probably give individual attention so that individual students really do well. So I think there is a room for both, and it depends on the company's philosophy in which one would probably need to go forward. So, and clearly, I don't want to take any names here, obviously, but every company has its own playground to play. And depending on what their playground is, depending on what is the propensity, there are other things. Obviously, you look at a balance sheet, what is the capacity of raising capital? All of that comes into play, right? If you really have sufficient capital that you need for the growth that you wish to do for the next 5-7 years, then you would probably try to utilize that before getting into another zone where you're dealing with, let's say, many number of owners. And like Giri mentioned, that in the absence of too much of institutional players here, if you're dealing with hundreds of owners, that's another thing to manage altogether. So I think it's a combination. There's no straight jacket answer, I would say.
Yeah.
It depends on the company's strategy.
No, very, very rightly said. The way I was also looking at it is that if there is an opportunity, which we kind of discussed, that the next maybe 3 to 5 years will be a great opportunity. If you really buy the land, get the approvals, build the hotel, it will take a hell lot of time. By the time actually it's start generating EBITDA. In that context, would having a management contract would that at least short circuit some of the processes and make it faster for you to be able to monetize the opportunity? That's the way I was thinking. That could that be the trend, because you have to be fast to the market?
Well, it depends on whether you want to create value in the long term or whether you want to see short-term profits. At the end of the day, the net realization from owned hotels in a normal scenario will always be way more than what you realize from managed properties. What you can realize from one hotel may be realized from 20 managed hotels. So Therefore, while it is easier, it may be easier, and not for everybody. I mean, there are hospitality companies which would be okay to get into brownfield projects, and there would be those who would say that even if it's a managed contract, I would like it to be built from scratch. So in that, the lead time is the same for both.
Got it. Got it.
Difference.
Got it.
Can I build on this, Sachin, very briefly?
Yes, please.
So I think a couple of, purely looking at it from a financial perspective, Sachin, what happens is that Kallol is absolutely right in sort of saying that one owned hotel may be equivalent to about 15 or 20 managed contracts. But the reality is that in a managed contract, the operator gets fees. In an owned, he gets the benefit of the P&L actually. I think the strategy that, for instance, some of us, we have adopted is a mix of both. And we have actually said 50-50. The reason we have said is that in times like this, when things are booming, I think owned hotels give you the benefit of operating leverage actually. And hopefully, and so therefore on the upside, the owned hotels give you operating leverage. And on the downside, the managed properties can give you resilience on the downside actually. So it's about operating leverage and resilience on the downside. Both I think are important.
Got it.
That's number two. What I would say is that I think the operating, and as Kallol also rightly said, it's not as if that a managed property is available from tomorrow. In fact, conversion of an existing property into a managed property is very rare. Usually an owner comes to you for before he has built anything, which means the timeline to start up a hotel, whether owned or managed, is not the decision factor here actually. The third thing I would say is that I certainly think that ownership of property gives you a lot of flexibility. So what we find, for instance, if I have to run a brand promotion, I don't need to ask all the owners actually. Because if I'm only running a managed property shop, then I would have to eat into part of my management fees before I run a complex promotion. Today, I don't care. If I have to run a promotion on Taj, I do it because, and if everybody benefits, that's absolutely fine actually. And the fourth interesting statistics, and I think your audience may be interested in this, is that sometime back we looked at the market cap analysis of the global hotels actually. Honestly, we had not thought too much in terms of our own market cap. And we suddenly realized we were about 12th or something in the list. And we said, gosh, we are 12th in the list. We had never thought of ourselves in that category. But more than that, what we saw was that from a market cap per room basis, we were the highest after host hotels actually. Host hotels is a REIT. And then we thought, why is this happening? For some of the competitors who have got millions of rooms, their market cap per room is lower. And we realized that maybe one of the reasons is that having a mix of owned and managed property is the secret to sort of getting better bang for the buck actually. And secondly, managed properties, what we have seen internationally, if you take what happens to international brands, I think, the way management fees work, Sachin, is that there's a base fee which is linked to top line. There's an incentive fee linked to profitability, and there's a reimbursement for expenses. That's the way the structure works. Internationally, what companies have realized is that when there's a downturn, you get a little bit of base fee for whatever top line you generate, but incentive fees disappear actually. Right. And then, therefore, what has happened in countries like the US is that many of the multinational chains do not manage. The two developments have happened. There are something called white label management contracts, which means you will see a multinational name on top of the hotel, but they are not operating it. It is actually operated by white label operators who do a good job at a lower cost actually. So either that we see, or we see franchises where I think the name on the hotel says a particular brand, but they're really run by the owners actually. So managed property thing is great in terms of building a network, lower capital, high ROCs, which is all good. But you need to balance it out with the fact that you are in an environment where you may not get the fees. Secondly, working in your own hotel, you are in your own hotel, so you are less worried about the P&L and balance sheet. Whereas if you're working for an owner, the same general manager who has moved from one of our own hotels to one of the managed properties needs to think very carefully about the P&L and balance sheet. The mindset is completely different actually. And the third factor I think which will impact eventually, I think, is the institutional ownership. Because where we have seen institutional ownership, especially pension funds own, especially in contexts like Europe actually, they actually prefer leases. Why? Because they don't want, in a managed property, what happens? The owner is responsible for his P&L and also the people. In a European context, the pension funds don't want people on their rolls actually. So they are happy to lease out the property to an operator, and they're happy to take a return on a lease rental, and an
Like
appreciation of the property.
Yeah.
So therefore, there are multiple factors which actually impact how the growth of owned versus management property will pan out. I mean, I'm trying to give you a very summarized explanation.
Got it. I think there is no clear single straight answer. And I've understood. I think your point about operating leverage, and especially when the market is good, obviously you will, the kind of returns that you can make. It's in some ways, to my mind, like equity and debt. Right.
Exactly.
So in debt, you have like a flat return, but equity you can get, a multi-bagger, depending on the economics and all that. Great. Let me get in Nikhil. Nikhil, in terms of the overall sector, during the COVID, we saw a fair bit of, compression on the margins, obviously, and then there was a sense that there will be consolidation and M&A in the sector. But we have not actually seen that. How do you read that, and what's your outlook on the same?
Sachin, just allow me to just piggyback on what Kallol and Giri said. And firstly, there's no right or wrong. It's the path each organization takes, right? In the year 2020 to 2022 is when most brands saw conversions globally happening from one brand to another, independent, and so on and so forth. Currently, what we are seeing, and this is a global phenomenon again, and again in India is the same, is 23, 24, you're seeing brownfields and greenfields coming up. So you're not seeing so much conversion happening, right? Globally, there is consolidation happening, and it will happen in India as well. It's a question of the market maturing to a certain degree. Just this year, Kotak Realty has invested 1,100 crores with Bharat Hotels, right? So it's a sign that the market is maturing. You're seeing institutional investment come into hospitality, or what Giri has done with GIC fund. So there is enough and more on that front. Consolidation is happening. I don't know if you've read, but Choice Hotels has picked up Radisson in US, which is 700 hotels. So globally, you're seeing consolidation. It will happen in India. Just to your point on managed and what Giri said, franchise, most international companies have actually morphed into more franchise organizations. And if I was to just give numbers out, and I'm actually naming brands, but this is publicly available data. Marriott globally is 73% franchised. IG is 84% franchised. Hilton is 88% franchised of their global portfolios, right? So if you're north of 70%, you're not a managed company. You're actually a franchise company. And to Giri's point, third-party management or white label management, that's what's happening globally. Are we seeing a trend similar in this part of the world? We are. Is the market mature enough? I think it is to a degree. We have, for example, 36 hotels in a pipeline, right? And 60% of that is actually tier 2, tier 3 cities. And these are all franchise operations. Everyone from a trader to a real estate agent to a builder are today actually building hotels. Now, it could be the ROE, but they're all looking at ROI at the end, and they're therefore looking at franchising.
Got it. So I think there is always some argument for the real estate players or the landowners to kind of monetize their land, in form of, apart from maybe some ego boost, which they may feel very proud of owning a hotel and all that. But otherwise, also it kind of can work out well. One question I had for Mr. Kallol, Kundu, and when I was doing some research and I read that you have managed a significant cost reduction during the COVID times. Now the question is, most of the industries are actually facing cost escalation. Either it was on the commodities side or it is on the labor cost. In general, we are all kind of faced with inflation. What is your sense? I mean, in terms of the cost pressures, could they return and therefore eat into the margins overall at an industry level? Is that how you see it going forward? Or do you think that whatever the changes that the hotel industry did are kind of sustainable and it will continue at those levels?
You want me to?
Element that really, and I'm pretty much sure that this would be applicable across the industry, not just for us. Maybe some have done it at a smaller scale, some have done it at a large, more institutional scale, organization-wide scale. It's, I think, technology that's going to decide finally where you're going with your costs. The broader you are in terms of your technology footprint, And the more you're able to convert your repetitive, routine, mundane jobs into technology, whether it's robotics, whether it's blockchain, whether it's bots, whatever you call it, the better. And it's better for two reasons. Typically, the first assumption that everybody makes on this is that with technology, your payroll cost comes down because you replace people with technology, and therefore the employee cost, which is the single most significant cost in the hospitality industry or the hotel sector, comes down. But that to me is actually the secondary reason. The more important reason is that if you really got to retain talent and attract top talent to the industry, then you've got to make human minds work more creatively. The more you make them work with or load them with mundane jobs and repetitive jobs, the less talented manpower you will be able to attract. So I think with technology, what happens is, and hospitality obviously it has so many endpoints that there are a significant number of areas where jobs are really mundane, routine, repetitive, and boring. If you can remove that very creatively and put that into the technology bucket and use the human brains to do creative stuff, whether it's in marketing, whether it's finance, whether it's in anything. I mean, for instance, we used to do in financial analysis. Quite a bit of the analysis can today be done using AI, right? So why would you really do something which you could do, in a different way, and you can then use the output of that for creatively thinking and as to how to really expand more and how to more delight the customer. I think that's where this combination of two things really helped. And overall, you see, it is a two-pronged approach. One is that it reduces cost. The other is it improves productivity. So if you take both together, I think it's a very, very potent weapon that we should all look out for.
Got it. Thank you so much. I think we are kind of almost spent about an hour on this. I would now request Mangesh to open the floor for questions from audience so that we can get some interesting questions from them as well.
Sure, sir. Dear participants, we will now begin our Q&A session. You are requested to key in the queries in your panel. Thank you.
So while the queries get, I have one more question, and that is about Airbnb. Is that something which you see as a threat in some ways in the medium to long term? It's already playing out. I think it's much more in Europe than maybe in India. Maybe Giri, you can share your thoughts on this. Yeah.
No, not yet in India. I think definitely it's more popular than it was earlier, but not yet in India. In fact, I was reading an article on Bloomberg just yesterday saying that even internationally, it's getting harder for Airbnb owners to kind of manage, actually. I think, so that is not so much of a threat. I just wanted to comment on the earlier point that you asked in terms of costs.
Right.
I think just one comment I do want to say is that the industry has taken a lot of steps in terms of cost containment during the pandemic. However, the reality is that the business has come back significantly above the pre-pandemic levels. And I think while the industry is enjoying great prices, I think we all need to remember that great prices come with great product and great service. It's a triangle. So great prices, product, great service has to be maintained, actually. You just can't charge double what you were charging and offer a shitty product and a poor service, actually, which means that costs have gone up. I think, and Kallol is right, that we are all focused on productivity. In the pre-pandemic, during the pandemic period, I remember in conversations in Jan, Feb, March 2022, I would tell the investors that with business hopefully coming back to the pre-pandemic level, I would still save on costs. But the reality is that the business came back at 125% above the pre-pandemic level. And therefore, costs have gone up and we need to be cognizant of it. And I think, but as long as productivity is maintained, that is clearly very good, actually. And Kallol is also right that technology helps. Service level definition also helps, because to some extent, I think one of the realizations that is happening in India is that we are probably over-servicing customers, actually. Like before your glass of water is half empty, somebody comes and refills, as an example, actually. So I think, whereas if you go to Europe or the US, it is the other end of the spectrum. So maybe there's a balance where even the customer is wanting less intrusive service actually. So if you actually listen to the voice of the customer and kind of tailor the service offerings, that also helps to manage costs actually. And costs are also not necessarily only the revenue costs. When I talk to product quality, I think it begins with renovations and construct and build actually. In fact, this industry is poor in general in terms of discipline on costs of construction actually. I think there's a lot of opportunity in terms of trying to have better costs of construction, which then plays out better from an ROC perspective also. So I think this whole cost equation is something which is yet to fully play out. And I sincerely hope that the industry kind of doesn't go back to ways when it will regret, because ultimately the cycle will change. Let's be very clear. Ultimately the cycle will change. But I think the industry right now, I think, is okay. I think working on productivity and doing the right things actually. Yeah.
Got it. So I've got a few questions. So this one, maybe Nikhil, if you can take this. The question is, what is your view on inbound foreign travel on a long-term time frame, say the next 5 years? Because I think in the presentation we mentioned that it is not fully recovered. So I think this is a question from R. Sriram. I think he's trying to understand what's the long-term view on the same.
So Sriram, firstly, thank you for your question. Inbound is definitely back, and this quarter and the next quarter, you will see more tourists coming in from outside. One aspect that we don't speak of too much is medical tourism, which is large for a lot of countries when they come to India. And that is back, and you will see a lot of hospitals that cater to medical tourism actually in the surrounding vicinity have mid-market upscale hotels which are actually full of medical tourism patients. So that's the other piece that you will see coming back. I know the government is again making inroads and wants to do a lot of initiatives, including weddings, and they want to promote India as a wedding destination. So you're going to see weddings have always been large in India. They continue to be large thanks to the shift that happened with COVID. You're seeing more and more weddings in hotels and not in gardens and banquet halls. So those are the two segments that are actually going to make sure that we see more inbound travel. And of course, business travel is back.
Yeah. Great. Thank you, Nikhil. Another question I've got is from Vijay Kumar Taukar. He's asking, even in tier 2 and 3 cities and several non-high profile tourist spots, I see that even the category of lower hotels is referring to ginger hotels kind of things also don't exist. When basically saying that there are not enough decent hotels in tier 2 and tier 3 cities. When will this change?
So that will change for sure, actually, Sachin, because I think if you take a country like the UK, which is tiny, it's got something like 700 Whitbread hotels, actually. I know. And if you look at travel lodges and others, it's probably another 2,000-3,000, actually. China has got thousands of the budget hotels, actually. And I think it's a huge market in India where I don't see why you can't have in every district a sensible hotel, which is kind of clean accommodation, with some all-day diner, which gives you simple comfort food, actually. 100-room properties. And
is that an issue of getting funding? I mean, is that maybe the bankers are not so comfortable and therefore it's easy?
It's not funding. It's not funding at all, because from a profitability perspective, remember that the ginger type hotels are actually the most profitable. Because what do you have? You have only rooms, and once you have built a room, you don't have any costs. So the room profitability is very, very high, actually. Unlike a 5-star hotel, which has multiple bells and whistles in terms of multiple restaurants and all that. And hence, I think the problem is not funding. In fact, you get a lot of lease rental discounting possible, which means when an owner builds and gives it to companies, lease rental discounting is completely possible. So funding is not a problem. I think the problem is, number one is what I call as Lego type construction capabilities, actually, where, you have a standard design, and with a standard design, how can you quickly keep factory? There are construction methods today where you can assemble everything in a factory and then bring it to the site and just put it together like Lego. We just don't have the technology fully in play in the country. We need some very quick ways in which construction can happen, actually. And of course, the approvals. And that is the only thing which is stopping, to be honest, actually. Other than that, I think the opportunity is massive in this space.
Got it. Great, thanks for your response. Another question I have is from Jatin Khandelwal. He's saying, and I also had a similar doubt, and so I will kind of combine the two. Is, what kind of return expectations do you typically have while investing in a hotel property? And my question was, if I look at the overall ROCE, it was straddling in the range of 4 to 5%. This is obviously at an aggregate level. Individual companies may have different, but 4 to 5% kind of an industry ROCE, and now in the best of times we're talking about 8 to 9%. Is that really the peak that we kind of see? Maybe Mr. Kundu, if you can take this question in terms of the typical return that we should expect in a hotel asset or a hotel company from an ROCE perspective.
Sorry if.
Yeah, sorry. You couldn't catch the question?
No, there was a network
issue. Okay. Now can you hear me?
Yeah, I can hear you better.
Perfect. So the question is, what kind of return expectations you have from investing in a hotel property? That is the question from Jatin. And my sense, if you can kind of, at an overall level for the companies, if I see, for the longest time, there was, 4 to 5% were the ROCEs that we saw. And now, in the best of times, we are saying it may go up to 8 to 9%. So is that what really is the peak ROCE that we should see, or is that something we are missing here?
No, I don't think so, because, I mean, again, it depends from organization to organization, and it depends on how you're going to chart out your strategy to maximize your ROC or ROIC, whichever way you look at it. But from the variety of measures that hotels have taken, let me start a little, let me take a little few steps back and say that when you look at an EBITDA at a company level, most companies you find are doing an EBITDA, overall EBITDA in the range of 35 to 36%, right? Which was never the case. Now, if you're looking at a 35, 36% EBITDA, definitely with more pressures on or more activities or more initiatives being taken on reducing corporate costs, etc., and with things like incremental revenues, higher ARR, and all of that happening. Higher ARR is one more point which is very important, because when the increase in revenue comes from occupancy, there's still a cost associated to it. But in case of a higher ARR, the flow through to the EBITDA is full. So certainly, my own calculations show that it should be easily possible for some, for companies to be able to do a ROCE of 14% and higher. Definitely, companies should strive to do a ROCE which is higher than the weighted average cost of capital. So really speaking, I did see that 9 to 10% of ROCE that you mentioned. Yes, it was traditionally the case, but traditionally the last 10 years, as I mentioned earlier, ARRs were relatively flat with cost pressures going up. So my sense is very clear that the ROCE has to be higher than that.
Got it. Giri, would you like to add anything to that?
Yeah, no, I think it's impossible to operate at 8 or 9% ROCs. Actually, you won't get capital. And I think the way at least we look at it is that if you look at a Ginger hotel type as an economy hotel, typically what happens is that, like we've seen in China, this segment of hotels typically has a payback of 7 or 8 years. Actually, that's what I would say. A 5-star luxury hotel can vary depending upon what goes into it. Like if you're building it in an island resort, or if you're building it to certain different specs, the paybacks can be longer. It can last about 10 years, 12 years and all that. I think so. It really depends on what goes into the cost of construction and building the hotel. But I think one thing to note in the hotel sector is that as the hotels mature, I think you will see that the occupancy stabilize, the revenue stabilize, and therefore for operating hotels, the ROCs tend to keep going up. Because what do you have once you've built the hotel? It's only the routine renovations which come once in a while. So for instance, we have seen, in fact, we have told our investors that for our operating domestic hotels, ROC is in excess of 20% actually. So therefore, there is no reason why you cannot get operating, hotels ROCs of that magnitude actually. I think, and the other factor which, I think Kallol also highlighted, which is on profitability. I think one of the most important things that the industry has started learning around is what we call as asset management. Asset management is making sure, like a retail industry, maximizing returns for the asset actually. And that also helps. Like, for instance, I'll give you an example of Taj Lands End in Bombay, which is a property that all of us know. We have a couple of initiatives we have taken, which is quite interesting actually. So, number one, for instance, behind the reception in Taj Lands End, we have set up a theater. Why? Because Bandra, it's right in the middle of the district where the cinema actors are there, and a 28-seater latest theater is now allowing you to do OTT screenings, weekend staycations for families, and all of that. It is a space otherwise which was there as a general manager's office. So general manager's office and non-revenue earning spaces become revenue earning. And the other thing about a business like this is that it's also cycle independent actually. It's not dependent on a hotel cycle.
Yeah.
So like this, each one of us has been taking these asset management initiatives which tries to get better profitability. Otherwise, where is the growth? You can't just depend on inflation-driven price increases. You'll have to work on all the elements to make sure it happens. So I think on the ROC side, I certainly think that the propensity to earn high ROCs is there. You need to carefully manage. On the lower economy segment, I would say ROCs can be very high. On the five-star hotels, depending upon how you build it, it is initially low, but over a period of time, it's actually very high, actually.
Let me just add to what Giri is saying. I can tell you for sure that ultra luxury properties, maybe the ROCs to start with is low in the first few years, but as they mature, in the 7th, 8th, 10th year onwards, you'll see an ROC of in excess of 100%. So therefore, that's true.
Wow.
Yes.
Okay, great. I think great. We had quite a interactive, engaging, insightful discussion. Thanks a lot, Giri, Kallol, and Nikhil. Really, enjoyed your inputs, and I'm sure our audience would have liked it as well. I'll pass it on to Mangesh to do a formal vote of thanks. But it was a pleasure interacting with all of you. Thank you so much.
Thank you. Thank you.
Thank you, Sachin, for moderating the session and Ravleen for your presentation. Thank you again to all the guest speakers for their insightful views. It was a privilege to host you. And thank you to all the participants for taking their time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us at corp.com@careedge.in. Goodbye for now.